Brendan, let me start with you. Bulls argue these protests are going to hasten the process of reducing lockdowns and increasing vaccination levels, so they're optimistic. But I get bears arguing to me that more targeted lockdowns are going to continue regardless of the protests. So what is your position? What are you telling people?
Well, certainly we've seen zero COVID evolve into dynamic zero COVID. So the government's been moving away from the very strict, the lockdowns right back in the spring with Shanghai. At the same time, they need a balancing act that they have a large segment, particularly their elderly population, is unvaccinated. So they don't want to hurt the economy. At the same time, they want to protect these this older generation. So I think the protests only accelerate the opening up process. You just have to move forward. The government's not tone deaf to what the population is saying.
Yeah, and the investing public seems a little confused about this. I watched China overnight. Hong Kong was down 1.5%. Shanghai was down 1.5%.
Yep.
A lot of big names were down, and yet we open here. China stocks are all up. Your K-Web is up 4% this morning. There's the Hang Seng. That's the close over in Hong Kong. I don't know. It seems a little confusing. They're not sure what to do with this.
Well, I think the key read is that within the Shanghai and Shenzhen, which is 95% owned by investors in China, is that you have all of the reopening trades were up. Restaurants, hotels, airlines were the top performing subsectors. And then this morning you have Pinduoduo, the big e-commerce company, absolutely crushed their Q3 financial results. Adjusted EPS was twice what analysts expected, as well as you have the PBOC on Friday after the close cutting the bank reserve requirement ratio. So some more support for the financial market. So I think you see a little bit of a pivot here as China gets back to business post-party Congress.
You know, Matt, you have the Spider S&P China ETF, GXC. It's down 30%. Everything's down 30%.
Yeah.
K-Web's down 30% this year. There's been a big debate this year in the investment community and the ETF community about how to look at China as an investment itself. At the very least, political risk seems a lot higher than we thought it was going to be 3 or 4 years ago. Is China becoming a sort of separate asset class? I'm trying to figure out how should we be looking at this, given all of this obviously increased political risk that we're seeing?
So I don't think it should be a separate asset class, but I think you can view it as a disparate, sort of separate allocation within a portfolio in trying to gauge your EM interest and your emerging market allocation. And, you know, perhaps going tactically overweight or underweight China based on your current views. I think when we talk to investors and they're trying to make a case for China within their allocation, there's sort of two aspects that I would look at right now. One is valuations, because the market is down so significantly, you know, down 30%. Valuations are relatively constructive versus broad EM as well as versus just the U.S. or broad global equities. And the second part is liquidity. It is one of the few areas of the marketplace where central bank liquidity is increasing, given the fact of the rate cuts by the PBOC, where the rest of the world, we're still going through rate hikes. So the valuation liquidity argument could make it as a standalone case for an allocation, not as a standalone asset class right now. But again, that's a huge contrarian play right now because of all that elevated macro risk. Forecasting that out, I think, is going to be inherently difficult, and that's why you have cheap valuations.
Yeah. You know, I'm going to ask you the same question, you know, Ben. Has the situation in China changed the way we should view global investing? So years ago, we assumed, all of us, when I did these ETF shows, investors should own their allocation of the world based on market capitalization. So if China is 15% of the market capitalization of the world, for example, then you should own a fund that represents 15%. And yet a lot of people are now, in the last few years, given what's going on politically in China, have questioned that, saying this may not be the only way we should look at this. There are other viewpoints that have emerged about this, from what I call the strict, we invest by market capitalization and we don't care where it is, to, well, you know, maybe we should reconsider and look at other metrics. Does this matter at all in the discussion?
Yeah, our clients are really struggling with how to play this market. And, you know, one of the things that's available now versus, you know, a long time ago is really the amount of choice you have in the ETF market. And that choice also creates a predicament as to how to position yourself in these markets. Right now, there's close to 50 ETFs that one way or another track China. And it's very important for investors really to look under the hood, which is one of the really great features of ETFs, to understand what you own because the performance differential, what those ETFs hold, and the risk that investors are undertaking is very different depending on which one of those products you're in. But historically, they've been underweight China. But here, again, it's been a kind of a struggle, and we're seeing mixed messages from our clients.
Well, I have to say, I'm much more aware of this argument than I was 3 or 4 years ago, Bob. We need to. You can't just look at market capitalization. Then I get the value guys. The value guys, they don't care about any of this discussion. If it's 15 times forward multiple or less, I'm a buyer. If it's more than that, I'm a seller. There's sort of like mechanical value guys that don't, Bob, you can debate the politics all you want. We don't care. We know we're value people. We know where our entry points are, and we get in and out. And that's another way of looking at the whole.
I think another way, too, is that on a market capitalization basis, and the market cap weighted indices are great for their use case as asset allocation tools, but they somewhat are different in how global GDP is generated. So they're much more geared towards U.S. equities, if you think on a global basis, where global GDP is actually more further, to the east, and you get more sort of global GDP generated in areas like India and China that are represented within market cap weighted indices. So sometimes instead of using just a global market cap weighted broad-based index, we say divvy it up and sort of try to reallocate a little bit more towards international stocks to be more reflective of how global GDP growth is generated. Problem with that is if you had done that in the last 10 years, you've really lagged that broad-based benchmark because U.S. equities have been so powerful. So it goes back to the valuation case where value stocks are international stocks right now. Value stocks are Chinese equities, but sometimes things can be cheap for a reason. So you need to look for sort of increasing profitability alongside that valuation. Sort of developed ex-US seems to be a better fit.
Sounds like quality, you're going for it.
Well, I think one issue in this debate is that, if you look at MSCI emerging markets and MSCI China 10 years ago, 50% of those benchmarks was financials, energies, and materials. So at the start of a decade of growth decadence investing, the big blob benchmarks were basically value proxies. And so this China's underperformed. No. Within MSCI China, do you know how much was in tech 10 years ago? 2%. That 2% did 2.5 times the performance of the S&P 500. So I mean, I think that's part of what we've tried to do at Crane Shares is give you really exposure to those growth elements within EM and China, which the broad benchmarks have really failed to deliver you.
China is an example of the value underperformance that happened here in the United States as well.
100%.
Yeah.
And if you had exposure within your EM or your China sleeve to those growth segments, you ran circles around the S&P 500. You just didn't get that buying the blob, buying the big beta proxy that you paid nothing for it, and so you got nothing in return.
So let me, so you're the China expert here. Let's go 30,000 feet. What's your best guess what happens here going forward? I mean, Xi Jinping, the guy in charge of China, is in a real dilemma right now. Yeah. If he essentially starts opening up, how can he do that without mass vaccination? I mean, he's really exposing the population. This is a very hard decision. They can't really keep locking down the country forever, but they're woefully unprepared, essentially, to open up. How do you get mass vaccinations, or am I keying on the wrong idea here? It seems like they're woefully under-vaccinated.
No, I mean, they've said the things they need is they need enough hospital beds, they need enough drugs in storage, and they need a lot more effort in getting the elderly vaccinated to fully move away from dynamic zero COVID. At the same time, they can't afford to hurt the economy. So I think it just accelerates this path toward reopening, and zero COVID is never officially going away. I mean, that's never going to be admitted that this was
because it's kind of part of the official doctrine, and they can't backtrack on official doctrine. They can only evolve the doctrine. I'm not putting words in your mouth. That seems what's going on here.
Yeah.
Right?
I mean, it's never officially going away. It will slowly recede into the background and slowly disappear. I just think what's happening right now with these protests only accelerates that trend.
Yeah. Any other thoughts on China?
Yeah, I would say it's a very tricky situation that China finds itself in. But again, on top of what's actually happening on the ground in China is really the macro picture of how it's impacting really investments globally, depending on whether or not China reopens, how quickly that happens, and really what the Chinese government actually does here, and how strict they want to continue this policy, and to the extent it impacts things like supply chain and other markets, really like oil, like we saw today, and other ways impacting supply.
Yeah. And China, it's remarkable. This is why I go back to the politics and whether political risk is higher. They chose to basically move away from the vaccines we were using here. They did not impose, I mean, they're imposing a crackdown on the country, but they didn't impose a crackdown to vaccinate people. That's what I find astonishing. It seems like they keep saying they're pro-science, and yet this didn't seem pro-science to me. It seemed more like somehow it's going to go away if we just isolate. It's not.
Yeah.
We know what this is like. It's extremely contagious.
Yeah.
The minute you open up, you're going to get big outbreaks now. And the only thing is to vaccinate the whole population as much and then keep developing better vaccines, it seems to me.
Yeah, I mean, I think the game plan is to move forward with promoting these inhalable vaccines where there's less stigma about getting a shot,
Wasn't there a nasal vaccine that was approved today?
Exactly. Sinopharm today,
Sinopharm,
after the Hong Kong close, announced that they're going into clinical trials. We've already seen the CanSino inhalable vaccine got approved for use in Shanghai. Right after that, 10 more cities signed on. So there's clearly a path to making the more digestible vaccinations happen. And big push toward the elderly.